Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenovec from Bloomberg Radio.
Well, Apple's upcoming AI features will arrive later than anticipated, missing the initial launch of its upcoming iPhone and iPad software overhauls, but giving the company a little more time to fix bugs. Apple planning to begin rolling out Apple Intelligence to customers as part of a software update coming by October. That's according to people with knowledge of the matter. So it does mean that the AI features will arrive a few weeks after that iOS 18 and iPad OS 18 releases that are planned for September, said the people who declined to be identified discussing unannounced release details. This writing and reporting coming from none other than Bloomberg News Chief Technology Correspondent Mark Gurman, who joins us now from LA. Mark, give us some context here for announcing something and then sort of waiting a little bit, at least in this instance, to do a broader rollout past the September release of a new piece of hardware, specifically the iPhone. Is this pretty rare for Apple?
It's a little rare, right? I mean, the expectation was that Apple Intelligence would roll out as part of iOS 18 in September. Actually, it's going to roll out, as I reported yesterday, as part of iOS 18.1 and iPadOS 18.1 sometime in October. And as I wrote yesterday, these features would go into beta this week. Actually, about an hour and a half ago, that did happen. Apple released the beta of 18.1 to developers. And so if you're a developer, have a developer account on your iPhone, Mac, or iPad, you can already try out the limited scope of the Apple Intelligence features. So long story short here, Apple Intelligence is not going to launch as Apple maybe made people assume it would launch back in WWDC in June. It's going to be a gradual rollout across several months, beginning in October for consumers.
Okay, so the beta is out. There's been about 90 minutes since it's been released. Mark, what are developers telling you about it? What are you seeing online about it? Have you gotten a chance to, do you have a developer's account? Can you play with it?
There's not a ton new in there yet. So the ChatGPT integration with OpenAI is not there. The notification prioritization is not there. What you do get are email notification summaries. So if you get an email, the text that normally would show the first couple lines of an email is no longer there. Instead, it's a 1 to 2 sentence summary of what is in that email. There's writing tools in there, so you can highlight something and have it change to a more conversational tone or a more professional tone or a more concise tone. One cool feature is the phone call recording is now there. So if you alert the person on the other line that you're recording the phone call, it will allow you to record that call and then give you a summary and transcription of that call within a note in the Notes application. There's the new Siri interface where you can double tap at the bottom of your phone now to do text to Siri. So if you want to quickly fire off a query to Siri instead of using your voice, that's now there as well. So that rollout is beginning for consumers in October, and developers can get a taste of it today.
So is the delayed rollout, though, of Apple Intelligence somehow dampening the sales outlook for Apple?
Yeah, I don't think it's really going to shift anything in terms of sales. I've seen some people speculate along those lines. That's why I didn't get into that yesterday. This is not going to be a major delay, a multi-month delay. This is probably a 3 to 4 week delay at best. Apple Intelligence, I would expect to roll out in the second half of October. The iOS 18 initial release probably in mid-September, so maybe a 1 month delay there. People are going to buy these new iPhones regardless, Apple Intelligence or not, but they'll know they'll be getting Apple Intelligence a few weeks later. And don't forget, you're going to get that initial bump of sales at the beginning of the launch in September. And then when Apple Intelligence launches in the second half of October, you're going to get another bump when people are talking about Apple Intelligence. So that is going to be quite significant news for Apple, or a good development for Apple at that time period as well.
What about iOS 18? Without the Apple Intelligence, what other new features in that software upgrade can we expect?
Well, there are some new features there. One is the new dark mode for icons. So you can now change your icon color to have dark mode icons for the first time. It actually looks pretty nifty. I've been using that. You can tint the icons to be any color you'd like. So you can change all your icons to be like purple or green or white or what have you. You can now also put your icons anywhere on the home screen. So it doesn't have to be in a single standalone grid. I've been testing it for a while. There's some other features there. Let's see. There's in Photos, there's a revamped Photos app. That's probably the biggest new feature. A bigger focus on curation, auto curation using artificial intelligence. So that's pretty cool. There's a new hiking view inside of the Maps application. So I think people will like that as well. Messages, you have a new upgrade to tapbacks where you can press and hold on a message. And instead of only having a few options like emphasize or like or dislike or heart, you can use any emoji. So little, tidbits there for what iOS 18 is going to bring, but the real story are the Apple Intelligence features that are going to be coming a little bit later.
Yeah, well, let's talk a little bit more about that and what's going to actually drive sales of the new iPhone that is likely, Mark, going to be unveiled in September, right? We don't have a date, of course, at this point yet, but this is the way it's worked in previous years. So Mark, give us an understanding of the way that, in this case, hardware perhaps will drive sales here, because in the past we've talked about more robust cameras, we've talked about more memory and different things over the years, or 5G, for example, different things over the years that have been available in new handsets that drive sales for Apple. What drives sales for this version of the iPhone?
Well, it's important to note that Apple Intelligence is only available on the iPhone 15 Pro. So it's obviously going to be on all the iPhone 16 models. And so you're probably going to see that contribute to sales. The other big thing is what is called internally the capture button. So you know how if you have a DSLR camera, you have the shutter button, the physical shutter button on a real Canon or Nikon or what have you, Leica, and you can press in a little bit to like autofocus. You press in harder to actually do the shutter. Well, the iPhones are now going to have a physical, standalone, dedicated camera button that operates just like a button would on a DSLR camera, where you press the shutter, or you can press in a little bit to do the autofocus. It's also going to have a little gesture area, so you can swipe your finger across that button in order to zoom in and zoom out. You can do that for video and for photos and other media capture. So I think that's going to be an exciting hardware feature for camera buffs out there. But certainly you're not looking at a redesigned phone. You're not looking at major new color options. You're looking at slightly bigger screens on the Pro models as well. But you're not looking at some sort of end-to-end revamp. So it's going to be the combination of those hardware tweaks for the camera, the bigger displays, faster processor, the new A18 chip line, and obviously Apple Intelligence contributing to that as well if you're coming from a pre-15 Pro.
We have earnings for Apple out on Thursday. What is the street going to be looking for?
We're going to be looking for any guidance related to that iPhone launch that gives us some indicator if there's a shift in timing. I don't believe that would be the case, but people are going to be looking out for that. And you'll be looking out for guidance on how iPhone sales are anticipated to do in the next quarter. That is going to be a good indicator of how Apple feels the iPhone is going to do because of Apple Intelligence, because of the other hardware features that I talked about. So eyes will be on that. Also wanting to take a look closely at wearables. The previous quarter, wearables didn't do so hot. Obviously, there's the conflict regulatory-wise with Masimo that prevents the blood oxygen feature from working on new unit sales of the Apple Watch. We're going to want to see if services continue to do well. And the big thing, obviously, is the biggest revamp to the iPad happened. The biggest revamp in 5 years, I should say, to the iPad Pro happened in May. So we're going to want to get some insight into the performance of the iPad line because of those upgrades. Quite a few people were waiting out for those. So you want to see if that pent-up demand did create some revenue boost for Apple.
Mark, what are the smart questions to ask about iPhone in China? Because we got the news last week from IDC that iPhone shipments there slid 3.1% in the June quarter. Huawei surged ahead. You had other smartphone makers surge ahead. What's a smart question to be asking about China?
Well, I'm not sure that the smart question is going to elicit any answers if you're asking about on the call answers of material data point, right? I think what Apple is going to stick to its party line. They're going to say we're going to present our numbers when we present them, and we're not going to speculate as to why these analyst reports say one thing and our data probably says something different. If you look at the analyst reports from IDC and other sources over the past several months, it's sort of been a roller coaster. Some quarters it says numbers are sky high. Some numbers say it's deep into the bottom of the ocean. So it's really unclear, and I'm not going to get into what they're speculating on. It's super unclear what their numbers are even based on. If they're based, I don't understand how a research firm can get a hold of actual unit sales of the products. They're not getting it from anyone inside of Apple. They're probably aggregating data based on receipts into email traffic. There's some cookies that can give you that data set. They're probably looking at how many people are buying them at the stores. They're probably seeking shipment data from the suppliers. I don't think there's a way to really get a really good hold on that data unless you're getting it direct from Apple. So I'm going to wait and see what Apple has to say.
Okay, well, we'll certainly be watching closely on Thursday when we do hear from the company after the market closes. Mark Gurman, Chief Technology Correspondent for Bloomberg, joining us out there in LA. Make sure to subscribe to Mark's newsletter as well.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Now to the micro view. McDonald's. While investors shrugging off the burger chain's first sales drop in 4 years as executives pledged to launch new promotions to help stem a decline in customer visits. Shares of McDonald's are up, though, and they were up as much as 4.6% earlier in the session. To get an understanding of what exactly is going on, we're joined by Mike Halen, Bloomberg Intelligence Senior Restaurant Analyst, joining us from our Bloomberg Intelligence headquarters in Princeton, New Jersey. So Mike, comp sales fell 1% from the year prior in the second quarter, fell short of analyst expectations. Each of McDonald's geographic segments saw sales declines. What happened this quarter?
Yeah, I mean, what they're seeing is, a global slowdown. It's not just the United States. We're also seeing it, in Europe, the Middle East, China, right? It's pretty widespread. McDonald's, like a lot of the companies we cover and most of the sell-side analysts out there, had expected a pretty nice bounce back in the second quarter after a first quarter that was pretty difficult, and it never materialized, right? And so low-income consumers are struggling, and they have been for a year, and it seems like their spending, especially their traffic patterns at restaurants, is getting even worse.
But Mike, the stock is up 4% right now. Investors don't seem to be exactly punishing that. How do you square the stock price movement and the earnings?
Well, first of all, coming in today, the stock was down 16%, right? And so really bad expectations were baked in, right? And the whisper number was definitely below what the sell side estimates were. So that's a big part, following Lamb Weston's really weak guidance of a couple months ago and weak results, following the data that we've been getting over the past weeks and months. That's been a big part of it. They didn't lower their guidance, which is a small win here, but for those reasons, the stock is doing a little bit better. Also, I would say that, investors realize that in a more promotional environment, in a much more competitive environment, McDonald's has the scale to win. Historically, they've done better than their peers in economic downturns because they have scale and they can offer prices that their competitors just can't match.
Speaking of that, a $5 meal deal to convince diners that it's still an affordable option. What do we know about early results from that $5 meal deal that was launched? And how is McDonald's able to do this in an era where all the costs have gone up substantially in the last 4 years?
Yeah, they can do it for the reason I mentioned previously, scale, right? They just have the purchasing power competitors can't match, right? And they're willing to try to draw consumers in on this deal that may not actually earn a profit, that maybe the franchisees break even or make a small profit, but actually improve traffic in the hopes that customers will add on to their orders. So this meal deal is doing okay, I guess. So far they said it's driving traffic, but there is some mix shift, so it's not actually driving sales. But they said historically, they tend to see an uptick in traffic before sales on these type of promotions. So they were positive that it could drive better results here through the summer. They said 93% of their franchisees agreed to run this through the end of the summer. So they seemed positive on it, but what the real initiative in the United States is going to be is revamping the value program. The 1, 2, 3 value menu is not resonating with customers. There's not many items on it. There's no items on there for $1 or less, and for that reason, customers haven't been very happy with it. And so that's going to be the U.S.'s main focus here in the second half and probably early into next year. And we expect them to spend a lot of marketing dollars to kind of support this revamp.
What do we know about the revamp? What will be on the menu? How much things will cost? And what could potentially drive traffic in and larger check sizes for the folks who do look to that value menu?
Yeah, I have a disappointing answer for you, and we don't know anything of, for competitive reasons, they're not out there talking about any of that. It's going to need some re-engineering. Right now, the menu has 12 or 15 items, mainly drink items. There's not too many food options, so they're really going to need a completely new menu and a completely new marketing program around it. Because what I mentioned earlier, they've gotten a lot of shade online about the fact that none of the items on there are $1. Maybe you're lucky in some markets to get something for like $1.50, right? And so, because of that, and because of the fact that they've kind of trailed on value, and they had some bad press around the $18 Big Mac meal, they still have some work. They still have some work to do in terms of reminding customers that McDonald's provides a great value.
I'm only chuckling, Emily, because it was like, that was just one instance, but it got a lot of press. I mean, I remember that, and it's not a company I follow closely.
Yeah, I mean, that is so much money.
It's a lot of money for a Big Mac.
Just a burger and fries. I'm wondering, Mike, what have you learned about the state and the health of the U.S. consumer from this earnings report?
Well, listen, restaurant sales have been weakening for a year, and we like to say it's a canary in the coal mine. Typically, the first discretionary spending that's cut is restaurants. It's typically felt first, right? And we've seen this slowdown by low-income consumers now for a year. And so what we're seeing now is the low-income consumer situation seems to be worsening, right? They've been dealing with all this higher inflation for the last 3 or 4 years by racking up credit card bills. We're seeing auto loan delinquencies and credit card delinquencies rise pretty significantly. So this tells us that the low-income consumer is still stretched, is still under pressure, and we don't really see any catalyst for that to improve in the near term. On the bright side, we haven't seen any comment or heard any commentary on middle-income consumers, but that obviously is the bigger fear, that this could spread to the middle-income consumer, creating a much tougher situation for restaurants.
Mike Halen, Bloomberg Intelligence senior restaurant analyst, joining us from Bloomberg Intelligence headquarters in Princeton, New Jersey. Mike, thanks so much. Do appreciate your time. McDonald's shares up by more than 4% as we speak.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, apart from the notion that some of their services overlap, big and small banks, community banks, credit unions in the U.S., they all have something in common. Well, most of them have something in common. Many of them are members of the American Banking Association. It's the largest banking trade association in the U.S. It's been around since 1875. It lobbies lawmakers and regulators on behalf of the banks. Here's a fun fact, too. The ABA also created that routing number that you see on the bottom of your check so your money gets to the right bank. That was all the way back in 1910. We got Robert Nichols with us, president and CEO of the ABA. Rob joins us from our Washington, D.C. bureau. Rob, good to have you with us. Thanks for joining us on Bloomberg Businessweek this afternoon. You talk to bank CEOs all the time. That's certainly a big part of your job. Get an understanding from them about the business landscape, how the banks are doing, what the challenges are, what they want you to talk about in Washington. How are the banks doing?
Sure, Tim, thank you very much for having me. I appreciate it. So banks are doing well. They're healthy, resilient, and serving the customers and clients and communities that are certainly so important. There are some things, though, that we're working on with the Biden administration and Capitol Hill, and that's kind of what we're calling the regulatory tsunami. There's just a ton of regulations impacting our nation's banks, particularly our nation's community banks, that are creating some challenges. And of course, we're pro-regulation. Regulation's super important. And you just want to get that calibration right, Tim. You don't want it to be too loose, obviously, but you don't want it to be too tight, which would impact credit deployment and capital intermediation, which is so important. It's the cardiovascular system of our economy. So it's that regulatory piece that we're really focused on at the moment to get that balance right. And that's everything from capital rules and fees and everything in between. And so that's a sharp area of focus for us right now with the Federal Reserve, the OCC, the FDIC, and the CFPB. And one thing, Tim, in your setup, we do represent banks of all sizes, charters, makes and models, from from all 50 states, but we don't represent credit unions. They're not in the American Bankers Association, but we've had a 150-year proud history of serving the nation's banks and really helping provide capital and credit that fuels the economy, which is important.
Let's get into some of those regulatory issues. Maybe you could start with talking to us about one of the most pressing issues that bank leaders are talking to you about. It'd be great to hear more details.
Sure, Emily, thank you. So I'd say a couple of things. One, obviously, the finalization of these capital rules. We think the regulators overshot a little bit, and I'd want to note and praise that Chair Powell did recently say that they're going to kind of go back to the drawing board on that proposed rule. We think that was the right step, so I wanted to appreciate that. So that's certainly one. There's also a series of debates in Congress around credit cards, and there's an effort to actually kind of strip the American people of their rewards cards. That's another thing that's certainly important. Interchange fees themselves, these are fees that actually help banks pay for fraud and cyber protections and also help bring the unbanked into the banking sector. There's a debate over how you can price those fees. Mm-hmm. That's another issue that we're focused on. And one other just broader conversation around fees. Every other industrial sector can charge fees for services. We think it's important that banks should be able to do that too. Those revenues to help keep the financial system safe and sound is critically important to the American people. And we'll certainly get into a robust debate with anyone about how we disclose and communicate to our customers and clients about those fees. But those are among the things that we've been dealing with. Reg II, a lot of acronyms, credit card competition, right. Capital rules are Rob, among the things.
I want to home in on the debit interchange fees, because the Fed has proposed lowering the fees on how much banks can charge for using debit cards to 14.4 cents plus 0.04% of the transaction amount. Bloomberg Intelligence estimates that this could be around $3.69 billion. Do you think the Fed is going to finalize the proposal, or should they go back to the drawing board? And then do you think that retailers will lower their prices as the Dodd-Frank bill intended, or will they end up pocketing the change instead?
Yeah, so you said it perfectly, Tim. They've not shown in recent history any price reductions for the American people. They said they would. It didn't happen. Okay, so that's number one. Number two, the comments that have all gone into the Federal Reserve have been incredibly critical of the Reg II proposal. So we do think they need to go back on the drawing board on that and show us the math. We'd like to see that as well. So listen, we work collaboratively, constructively with the Federal Reserve on many, many things, but on this one we just don't see eye to eye. And in fact, there's some other Fed governors, too, who've also aligned themselves with our view to say, yes, we need to take another look at this particular regulation. It's important. And listen, we, again, want to work closely with them, but we do think that one ought to go back to the drawing board as well.
Hey, Rob, I'm wondering how you're looking at fintechs right now, because I think consumers might not understand that if they're quote unquote banking, using banking services or what appear to be banking services, they might not actually be working with a bank. They might have an account with a fintech that offers 4.5% interest on cash. It's pretty appealing to a lot of people, I think. But there are also some challenges too that come with that. A lot of these fintechs partner up with banks rather than being banks themselves. How do you look at fintechs and the relationship that they have with banks?
It's a great question, Tim. So two-part answer. The first part is on the policy piece. If someone wants to do bank-like things, fintech company or credit union or anyone else, or crypto, if they want to do something bank-like in terms of taking deposits, loans, or payments, they should be subject to kind of bank-similar supervision from a safety and soundness and consumer protection standpoint. So one, there's just the policy piece to make sure same activity, same regulation. But then, to your point, banks work incredibly closely with fintech companies to enhance the customer experience. We at the American Bankers Association have a great group of people led by Brooke Ybarra, who's a fantastic executive, where we meet with fintech companies constantly, literally on a daily, weekly basis that want to partner with banks to improve the customer experience. So that partnership model we think is incredibly important. But then more broadly from a policy standpoint, we do want to make sure if any entity, crypto, fintech companies, et cetera, wanted all the kind of the folks in the shadow banking system, if they want to do something bank-like, we're all for just competition. We just want a level playing field. So we want to make sure same activity, same regulation.
we don't have a lot of time left, but we can't let you go without asking about the upcoming election. Who's better for the banks, Rob, Harris or Trump?
So we don't get involved in presidential races, Emily, but I will say we will work with whoever the American people send to Washington next year. And if it's former President Trump or Vice President Harris, we will work incredibly collaboratively with their team to make sure that regulatory balance is proper so that the U.S. banking system can serve the U.S. economy in the manner that we need it to. And so I don't know, not here to make a prediction today. We don't get involved in presidential race, but we're going to work with either the future President Harris or Trump very closely.
20 seconds, Trump's comments over the weekend at the Bitcoin conference, net positive or net negative for your members?
I would say this on crypto. We want to make sure that it's regulated. There needs to be regulation. There isn't, and I'm heartened that Republicans and Democrats alike, and both of the major candidates are talking about some sort of regulatory architecture around crypto. I think that's good.
Rob, really appreciate you taking the time. Rob Nichols, President and CEO over at the ABA, American Bankers Association, joining us from Washington, D.C.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, last Thursday, shares of Republic Services, the $60 billion market cap waste management firm, fell more than 5% after the company cut its full-year revenue forecast to below analyst estimates. Republic Services did, however, boost its adjusted earnings per share guidance for the full year, beating the average analyst estimates. Who better to talk to about this than the president and CEO of the firm? Jon Vander Ark is president and CEO of Republic Services. He's back with us from Michigan. Jon, good to have you. It's been close to a year since we last spoke. How are you?
I'm great. Thanks for having me back.
Yeah, thanks for joining us. Hey, talk to us a little bit about the guidance cut for the revenue forecast. What's going on there? What happened there?
Yeah, I think it's all macro. I think we probably 8 to 9% of our business is related to construction. And, we've had a protracted high interest rate environment, and we're just not seeing the home starts or the commercial starts that we expected. Again, we didn't plan for a big year, but it's been pretty depressed. And so that is really the bigger driver of that coming down. And the second more modest thing is we had a couple of projects that were delayed in start for the year and kind of, missed out on probably 25 million of revenue in the first half. Those are just timing delays. Those things are up and running now. And even with the construction, right, we think that's transitory, right? We're really excited about the next 10 plus years of the housing cycle because we think that they've underbuilt homes in the United States for a long time. And so, listen, the outlook of the business is very healthy. We raised our EBITDA forecast as well. So we're putting plenty of money to the bottom line as well. So our outlook is strong.
When do you see the construction business turning around?
Listen, we would have thought it would have already happened already. People were talking about rate cuts, and then it was going to be, 1 or 2, and then it was 0, and now we're back to 1 or 2. I don't know whether it's 3 months or 6 to 9 months. I think we see in our business lots of things kind of slide to the right during the election cycle just because of uncertainty. And I would expect by, Q1 of next year, things would be really moving again.
So tell us about how your company is leveraging automation right now.
Yeah, a number of different ways. We certainly do that on our trucks. So, you've seen the trucks go around that, you used to have 2 people on a truck. Now you have a single person working on the automation. When we're actually tipping that container, we're using AI machine learning to actually scan that stream on recycling to see if it's contaminated or not, to make sure that we get garbage in the right place and recycling in the right place. In our recycling centers, that there's a ton of sophistication in terms of separating the different material streams so that we get paper segmented from the glass, from the cardboard, from the aluminum, and from the different types of plastics. And then all the way into our customer service and our call center agents for using AI co-pilots next to them to make their job easier and more efficient.
I was thinking, as you were talking about the housing market, I was thinking back to a conversation we had last Wednesday with Whirlpool CEO Mark Bitzer, who joined us after earnings. He basically said the same thing that you did, Jon, that he's surprised that we haven't seen the housing market come back at this point because, 6 months ago, a year ago, he would have thought it would have recovered by now. Really interesting stuff. Okay, more on sort of AI and automation. when it comes to routing, pricing, fleet management, what's the savings potential you think you could get from tech?
Yeah, we put in our Rise digital platform, and so that's using automation to route our 15,000 plus vehicles that go out every morning. We think we're going to get $100 million. We've already captured more than 65 million of that over time, and that's really just the first wave. And that's not really even using any of the AI to build the routes. That's our next frontier in terms of combining that with people's local knowledge and putting those two things together. I think there's another wave beyond the 100 million. And that's just in our core operations of our fleet. So I think automation over time touches almost area of our business. And it's certainly savings, and we're mindful of managing the cost for our business. We also think about making the employee value proposition stronger because people are our product. And so we think about technology not as replacing people, but as empowering them. So how do we provide a better product to our customers and make the experience of our colleagues better at the same time?
Talk a little bit about plastic recycling. We know that you've made some new investments in new polymer centers. What should we know about that?
Yeah, most plastics today, rigid plastics, so you think about a water bottle, a detergent bottle, a milk jug, gets downcycled. It goes into a pipe, a park bench, a carpet, which is good. It gets a second life, but that's going to be the last life for that product. And what our Polymer Center does is we're going to have 4 of them across the country. The first one's opened up in Las Vegas already. It takes all of those rigid plastics and it perfectly sorts them in a way that it eventually can clean up and create food-grade plastic PET flake or olefin flake that ultimately can go back into a food-grade product. So think about a water bottle taking about 120 days, putting it in your curbside container, and then getting it back onto the shelf as a water bottle again 120 days later. And for us, that's a great business opportunity. I think it's a very tangible example of sustainability and circularity, right? That's really taking something that's going to have one life, and we think that molecule could have 6, 7, 8, maybe more lives. We don't know yet, but certainly going to be good for the environment. Again, good for our investors as well.
In 2023, recycling and solid waste made up the vast majority of your business, 89.1%. Environmental solutions coming in at 10.9%. What's the opportunity when it comes to environmental solutions? The U.S. ecology acquisition, PFAS cleanup opportunity. How do you see, given those things, how do you see the shift in revenue changing?
Yeah, last year we did about 1.6 billion in that environmental solutions space, and we think that's a $30 billion plus market in North America. So you can tell right there, right? We've got a lot of share potential, kind of a 5-6% share player, with lots of opportunity for growth. And PFAS is a good example of a very technical waste stream that society is grappling with right now. We want to be the ones to remediate and take care of that. Last year we did about $70 to $90 million of PFAS revenue, and this year we're on track to beat that number. And I think that's early days. As the regulations come out, I think that's going to create a bigger market opportunity for us. And again, we don't run away from those technical challenges and those hardest problems. We want to be the ones to solve them because we care a lot about environmental responsibility. We want to be the ones who are in the middle, cleaning up the most challenging problems for society.
So in your business, you have a very large fleet. You have to transport goods, and that requires vehicles moving around. How are you guys dealing with keeping that line of business sustainable while also having a large fleet of vehicles?
Yeah, so 15,000 plus routes, 18,000 vehicles, because we have some spares in the system as we think about preventative maintenance, et cetera. So we're bullish on electrification. And so we've got more than a dozen vehicles today. We're going to have 60 or 70 by the end of this year, and we'll have more than a couple hundred in our fleet next year. And our application is perfect for electrification because versus an over-the-road context, our trucks come back every night to the facility. Our charging time is overnight, and that's during the off-peak hours for the grid. So we're very friendly with the utility in terms of their power plan throughout the day. And we've got a partner, Oshkosh, who's built the first purpose-built refuse vehicle ever. And that's really cracked this nut of how do you get enough weight off of the vehicle to put enough battery power on that allows you to run a full route for the day and carry the full payload of the recycling or waste load. And their truck does that. We've got 2 operating today. And again, we'll have more than 50 in the fleet by the end of the year.
Hey, John, we only have 30 seconds left, and I know CEOs love to be asked about competitors. So Waste Management buying Stericycle. M&A, thoughts on that merger and how things will pick up? Just 30 seconds.
Yeah, listen, we're the great-grandchild of 1,000 acquisitions, and so is everybody else in this space, and it's a slow-growth industry, so M&A is an inevitable trend. I'm sure they'll do a wonderful job with that acquisition. They're a well-run company. We don't see that as a loss for us in the sense that we've got a robust M&A pipeline, excited about where we grow in recycling and waste, environmental solutions, and even sustainability, innovation, the circularity and sustainability opportunities I talked about earlier.
John, we love talking trash with you. Jon Vander Ark, President and CEO of Republic Services, joining us from Michigan. Next time you're in New York, come hang out with us again in the Bloomberg Interactive Broker Studios, because that was fun last year.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, there it is. 18 minutes to go until the close of trading. We just got the numbers from Charlie, but worth repeating. We're seeing some grain on the screen, just a little bit, with the S&P 500 and the NASDAQ. The Russell 2000, though, which has been up over the last 3 weeks, down 1.1% today. Let's see what Cheryl Smith, economist and portfolio manager over at Trillium Asset Management, has to say about this. She joins us from Cambridge, Massachusetts. Okay, it's a huge week because we have the Fed on Wednesday. They kick off their policy meeting tomorrow. We get jobs numbers for the month that we're in on Friday. Cheryl, what's top of mind for you?
The jobs numbers are definitely top of mind. I say that while the Fed is important, it's pretty clear that they are not going to cut in July. That probably expectations are they're going to be cutting in September. So most of the discussion about the Fed is going to be exactly the nuances of some versus many versus most.
Okay.
Think that activity is possibly increasing, whatever. They're going to be, fudging around with the numbers. So I think the really big data for this week is the unemployment figures.
Okay, you're in a position where I would say you're not necessarily an outlier right now, but you're urging caution according to the notes that you sent to our producer, Paul Brennan. You're looking that there are some indicators right now that are consistent with recessionary levels. Talk to us a little bit about what you're seeing ahead.
Sure. And what I'm seeing is a labor market that, while it looks okay on the top level, we haven't yet reached the level of the SOM rule, which would be an increase of 0.5% in unemployment in a 12-month period. We're quite close to that. We're at 0.43. But internally, what we're seeing is if you look at the unemployment numbers for Black workers, if you look at the unemployment numbers for Latino workers, if you look at the unemployment numbers for Asian workers, those have all moved up materially, but all meet the SOM rule in and of themselves. The broader workforce of white or Caucasian workers has not yet reached that level. The other thing that we're looking at is on a sector level, the industries where the sectors where we're seeing employment gains continue to be made are very non-cyclical areas. They're healthcare, education, and government workers. Everything else with any kind of cyclical nature to it is already seeing considerable declines. And then the third element that makes me quite concerned is a real big difference between what we see when we look at the household survey and what we see when we look at the establishment survey. So the household survey shows only 355,000, roughly, increase in jobs for a 12-month period, whereas the establishment survey sees 2.6 million jobs created over that period of time. That's a very big divergence. Usually when there's a divergence, it gets adjusted back to where the household survey is. So that would indicate that we could be seeing a very large revision downward in what we had thought was the employment picture coming up fairly soon. And I go back to, I'm getting long-winded here, but I go back to the recession in 2007. Not that in any way I'm thinking about the depths of that, but there was a big revision in the labor numbers as we moved into that recession. It had looked like employment was increasing, and then in retrospect, employment had already started to fall at that period of time. So it can make a big difference.
Okay, so the market wants the Federal Reserve to begin cutting interest rates as soon as possible. What's your take? If we don't get a cut, is that necessarily going to be bad for portfolios? Or are you in the camp that we do need to see this cut pretty soon?
I'm in the camp that we need to see it pretty soon, but I think the September expectation is appropriate at this point. I don't know what other people are seeing that they're expecting it to be on Wednesday. When you look at the summary of economic projections that was released in June, what you see is that as a group, the Fed governors decreased their expectation for what GDP growth was going to be. They increased their expectation for what unemployment would be, and they increased their expectation for what the PCE, the indicator that they look at for inflation, would be, even though over the 3 months difference between that time and the time of the previous one, the PCE numbers have gone down. So there's something happening in the dynamics of the Fed meeting, or in somebody's expectation there, that service inflation in general, is just much more embedded than what the market is seeing. Now, from a perspective of market activity, certainly in mid-July, we saw a huge rotation into the smaller caps and away from the mega caps. Overall, I think the mega caps, Magnificent Seven, the AI trade has been very, very overextended. So there's probably some benefit to see those trades be cut back a little bit. But I think it's too early to be rotating into the small cap companies and expecting them to be benefiting from a decrease in interest rates happening right away. The market seems to be looking for 2 or possibly even 3 cuts by the end of the year. I just don't see it in what the Fed is saying and what the Fed is projecting, unless we get a much worse economic outlook, in which case, if the Fed cuts rates, it's still not going to help those kinds of companies.
So too early to rotate into small caps. Does that mean that you're adding to the U.S. mega cap positions right now?
I think what we're doing is looking at more second tier. So the Magnificent Seven have been are very extended. There's just no way to say it. The last couple of weeks have brought them close to their 150-day moving averages. They're looking a little bit more reasonable on valuation. They still have the earnings, though, to support continued growth, whereas many of the other companies are just not seeing quite the same amount of earnings power. But I would be looking at very large cap, mega cap, just not the top 10 companies. That's just a level of concentration that I think we are going to need, the market is going to need to back away from. It's at the kind of level where whenever we reach that, we see that that level of concentration decreases. Hopefully we'll see that happening by the prices of other stocks, the other 490 stocks in the S&P index increasing rather than by the top 10 falling dramatically.
Cheryl, before we let you go, just in the last 40 seconds that we have with you, you argue that U.S. domestic politics is a key risk. How should investors think about November?
I would put a lot of armor on. I think it's going to be very volatile. We're going to be seeing dueling polls come out day after day, week after week, and everybody's going to be arguing, is the quality of the polls good? We're going to be looking at predicted. We're going to be, the market's going to be looking at this as very much of a horse race. The withdrawal of Biden and the ascension of Harris has very much upended the playbook. The market had pretty much settled on the idea that Trump was going to win it. And not only that, the Republicans were going to win the Senate. And not only that, the Republicans were going to take the House. So I think that is not at all a settled conclusion at this point.
A lot changed in a very short amount of time. Cheryl Smith, economist and portfolio manager at Trillium Asset Management, joining us from Cambridge, Massachusetts.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.